How are we getting on, people? Luke here from LAGFX. We are back today with another Learn to Trade video. In this episode, what I'm going to do is dive into the markets and show you exactly how I go about 1, analyzing the markets, 2, finding a bias, and 3, placing and executing positions based on the confirmation and confluence I have got from my analysis. Hopefully, I can answer any questions that you guys have surrounding this subject and how I actually go about placing positions in the market. If you are still unsure with my step-by-step guide that I'm going to go through today, leave a comment below. What I'm going to do is I'm going to set up a webinar on the LAGFX website and give you guys an opportunity to speak with me in this webinar, and we can go through everything step by step again, allowing you guys to actually answer live questions. And I think that way we'll be able to fill any gaps that we have in knowledge when it comes to actually placing and executing positions based on the way that I like to trade. So as you'll see on screen, we have the AUD USD market up. You'll also notice that I have a 10-step guide to actually placing positions. So what I want you guys to do now is just pause this video, take a screenshot, so you have this here. This 10-step guide is vital when it comes to actually placing positions and doing your analysis. And I think if you can follow this 10-step guide, then you will see an immense amount of success, assuming that you follow it accordingly. What I'm going to do is go through each step with you now as we go through this video. Then within this video, I'm going to show you examples of where we've placed positions prior and then where we can actually look to place positions moving forward, okay? So jumping straight into things, as I said, this is the AUD USD market. I'm looking at this on the 4-hour time frame, okay? So what we need to distinguish straight off the bat is this a bearish market or is this a bullish market? Well, what we've been able to ascertain just by looking at the structure that is being presented to us is that it is a bearish market. Why is it a bearish market? Because price has started up here and at the moment it's down here. Therefore, price was higher in previous data and it is now lower than what it was, okay? So that is just going based off logistics and just looking straight at it, right? Now, if we were to look at this in more of a structural way, we could say, well, actually, this market is providing us with clear bearish structure. Why? Well, as we can see, price is producing clear lower lows and lower highs in the market. Again, that is helping develop and find our bias. So not only have we been able to look at the market and see that this market is bearish, but on top of that, we have been able to find clear structural lows and highs within this market, which has basically given us the confirmation that this market is trading bearish. So realistically, we want to be trading with the prevailed trend. We don't really want to be trading against it. We can look to place maybe scalp-like positions on corrective waves, but realistically, we want to be waiting for the corrective waves to be finished and the next impulsive waves to take place. We always want to look to get involved just before the next impulse takes place in the market. So in a bearish market, all of the impulses start at the end of a peak that has been created. So as we can see, these are the peaks here. And then price goes on to create its impulse. Yeah, so these are impulses. This will be its next impulse, hopefully. And then we have our corrections. So if I just change the color of this, you'll see here that these here are the corrective waves. So realistically, when we go to place positions, we want to be getting involved here. Why? Because when we place our sell positions here, our trade is going to go straight into profit and we aren't going to see any kind of drawdown or SL hits. That alleviates that problem straight off the bat. However, if we were to get involved here on sell positions, our trade is going to go into a hefty drawdown before it goes into profit. So you can see just from that why we want to get involved at the end of a corrective wave and the start of the next impulse. And the same applies for a bullish market. The only difference with a bullish market is we look to get involved at the troughs rather than the peaks. So we look to get involved at the lows that are created because within bullish structure, price creates higher highs and higher lows, where the lows are protected and the highs aren't. And then in this case, the highs are protected and the lows aren't. So once we have found a bias and we have understood that we need to trade with the trend and not against it, we've then looked at the overall structure of the market and ensured that our bias is right by looking at the structural laws that have been presented to us. Then what we need to do is mark out the swing points. This helps determine our stop loss and take profit when it actually comes to placing positions. Now I'll go into detail as to why later on in the video, but all we need to do is just mark out these swing highs and swing lows. So you'll see here that I have done this. I have set lines out here. I've got 3 lines at these 3 troughs that have been created. Then all we need to do is do the same here. Then once we have that, we have our swing point. So we understand that realistically, if this market was to continue following bearishness, we shouldn't see price come to surpass these lines that have been created. So the lines that have been created on the peaks, price shouldn't come to surpass that because we are following bearish structure where the highs are actually protected. So this is just another way of kind of giving us a barrier and a region to work with. Now in terms of the troughs, we understand that price should surpass those. Okay, and price should go on to create new lower lows as that is following bearish structure. But when it comes to placing our take profit, we want to set our take profit just above the previous structural low. Why do we want to do that? Because that guarantees that our take profit can and will be achieved when we look to place those sell positions based on the next impulsive wave that takes place. Okay, low in the eyes of a bullish market, always place it just below the previous high in the market. Okay, so once we have distinguished our bias, we understand that we need to trade with the trend. We've marked out our swing points. What we need to do then is wait for an impulsive wave to finish. As soon as the impulsive wave has finished, we then understand that a corrective wave is inbound and we can actually look within the impulsive wave that had just been created for any areas that price could trail up into and deliver us with that reversal power. So once an impulsive wave has finished, we then know that a corrective wave is inbound and it is going to trail up somewhere in order to grab enough supply or demand, depending on the direction of the market, in order to get that reversal power and flip the supply and demand balance to basically initiate its next impulsive wave. So if we just go to this impulse and correction as an example, we can see that we were delivered with an impulsive wave taking us lower into the market. We were delivered with a break of structure to the upside. So this tells me that this impulsive wave here that has been created has now finished and the corrective wave is inbound. So we are going to see price continue trading bullish until it has penetrated or found enough supply in the market to essentially reverse and change the direction of the market, creating its next impulsive wave lower. Okay, so as soon as we have confirmation that this impulsive wave has finished, we can then look within this impulsive wave for supply zones. In this case, it's supply zones because we are looking at trading bearish. We are looking to play sell positions, so we want to be looking for supply zones. And again, just to reiterate, why do we need to wait for a break of structure to take place before we can look at supply zones, essentially? Because this is confirming that this impulsive wave is finished and the corrective wave is underway. Okay, so we've had a break of structure here to the upside. This was the last protected high that was created within this bearishness. We've seen price penetrate above that, so we can highlight the entirety of this impulsive wave. So we understand that we are looking for any inefficiency, any unmitigated areas that price could trail up to grab and clear any remaining supply in the market in order to actually reverse the market and create its new impulse. What we can also do is we can use the Fibonacci retracement tool. This is something I used to use when I first started my forex career. I would use the Fibonacci retracement tool. I would look for the golden ratios and I would look to potentially sell from these golden ratios, assuming we were delivered with the right confirmation. So the golden ratios are the 61.8, the 50, and the 38.2. We can also look at the 78.6, although that isn't as reliant as the 3 golden ratios are. So that's another option. Me personally, I like to look for supply and demand zones, so that's exactly what I'm going to do. So I can see here that everything from here downwards has been cleared by this up thrust here. All of this seems to have been cleared as well. On the way down, it looks as though everything has been cleared on the way down. So the only inefficient structure, realistically, is this last buy to sell zone and then potentially this as well here. But we can go down in time frames just to get confirmation of that. So it looks to me as though this has actually been cleared through these candles here on the way down. I would maybe highlight this as a potential region for reversal. All of this looks to have been cleared on the way down. We can see how price has come back up to tap into these last buy to sells. So for me, it would just be this region here. It looks as though within my prior analysis, I have actually refine this, but I would refine it to this last buy to sell region. So once we have found our supply zone within a bearish market, if we were trading a bullish market, we'd be looking for demand zones. So once I have found my supply zone, my last buy to sell region, all we need to do is wait for price to trail up into this zone, deliver us with the confirmation we need in order to then execute our sell positions. So price trailed up, as we can see, price continued to trail higher, taking us into this supply zone. We have then been delivered with a distribution, it looks, and we've had multiple pieces of confluence to tell us that this market is actually ready to reverse and that demand has been exhausted and the supply is taken over in this market. So the bulls are exhausted and the bears are ready to take over. So we can imagine that there are a load of sell orders waiting to be activated around this area. You might be wondering, well, would we just enter on the basis that price has penetrated the zone and shown some rejection? Would we just enter then? No, what we would need to do is wait for further confirmation before we look to actually execute our positions. This is just helping build our probability and our confluence in order to actually be profitable if we were to place sell positions here. So if we look through our list, we have gone through step 6. We have waited for price to trail into our point of interest. Now we need to look for a break of structure after the tap of a POI. If we just go back to this, we can see here, this is the last higher time frame structural low within this corrective wave. And this here is the last fractal structural low within this corrective wave, okay? So what we do essentially is highlight these lows, these protected lows, as I have done, and wait for price to trail below them. This would then tell me that this corrective wave that has taken place has finished and the new impulsive one is underway. Why? Because in bullish structure, the lows are protected and the highs aren't. So we shouldn't see a break in these lows, right? So when we see a break in these lows, that tells me that price is now following bearish structure, because as we can see, each low gets broken and a new lower high is created, which is always protected. So it's no longer following bullish structure, it is now following the laws of bearish structure. So this bullish corrective wave has finished, and now a new bearish impulsive wave is ready to take place. So I hope you guys understand the true importance of breaks of structure and why they are so powerful when we look for reversals in the market, because it is literally telling us that one trend is finished and the next trend is ready to go on and be created. Okay, so if we were to place a position based on a less refined entry, and if we were just to stay on the 4 and 1 hour time frame, we could essentially place a pending order at this structural low here, have our stop loss above the structural high that has been created, because this is above the point of interest that is holding enough supply in the market to keep price beneath that. But on top of that, we have set it above these structural highs, which are now seen as protected as we are following bearish structure. In bearish structure, the highs are protected, the lows aren't. So we shouldn't see price surpass these highs realistically. So we could set our stop loss just above these structural highs that are created, and then our take profit at the previous swing low. As I said to you earlier, we always want to set our take profit just above the previous swing low if we are following bearish structure, and in bullish structure we always want to set our take profit just below the previous swing high that was created. So as we can see here, this trade in itself is offering us a 1 to 4 risk to reward ratio. We have waited for every piece of confluence and confirmation we need in order to execute, and we are literally just placing our position based on the break of structure that has happened here. So that has given us a brilliant risk to reward ratio, a 1 to 4. If you're risking 1%, you're looking at nearly 4.5% returns from this position. Now, if you are like me and you want to make the most out of your trade and you want to make the most out of your position and really increase your risk to reward ratios, then what we could do is we could actually look at going down timeframes and looking at this distribution in a fractal way, allowing us to actually refine our position. So now just going down to the 15-minute time frame, we can see how price is following a bullish structure. Let's just highlight this. Then you'll notice that after creating these higher lows and higher highs, price actually starts to set bearish structure. You can see how we have higher lows and higher highs here, and then we have a lower high and a lower low get created, and then we have another lower high, and then we obviously have lower lows being created. This would be the break of structure here. So this is following bearish structure, so that in itself is telling me that we are no longer following this bullishness and price is ready to go bearish. So we've been able to see that and being able to ascertain that by looking just fractally at this market on the 15-minute time frame. So if I just get rid of this, so like I said to you earlier, we want to wait for a break of structure around these points of interest so we can look to execute. So once we see what was a structural low here, a protected low that shouldn't be broken below, break, that is our first suggestion that price is ready to go bearish. Not only have we had that, but we've also had a lower high created, and then we have another lower high created. These highs come lower than this one. Then we have another break in what should be a protected low. We have a break in that, price has come down and traded beneath that. So that in itself is telling me that price is following bearish structure. So on the basis of seeing that, we could then look to place a position slightly higher, giving us a greater risk to reward return on this position. So now our stop loss is a little bit more refined. Our entry is a little bit more refined. And let's see what our risk to reward ratio is looking like now. So you can see that we now have a 1:6 risk to reward ratio. So where it was a 1:4 previously, we now have a 1:6.5. So we're now looking at potentially gaining back 6.5%. Now, if you really wanted to refine your entry, this is where things get tricky and you need to be careful not to slip into fractal structure too much, is we could look to go down on timeframes yet again. So let me just get the replay button. If we now look at this on the 5-minute time frame, okay, so we can see here how price is following clear bullish structure, okay. This is the first anomaly right here, and this is the second anomaly. Why? Because this high comes lower than this one, and this low comes lower than this one. So this is the start of bearish structure, right? So we now understand from this here that this corrective bullish wave has finished and bearishness is actually inbound. So what we could do is we could look at the impulsive wave that broke structure, which is this one, because as you can see, this was a structural low. Price came to break this. So this is a break of structure. So we could then look at the impulsive wave that broke the structure, being this one here, for any inefficiency in the market, any unmitigated areas that price could come to trail back up into. Well, I can see a last buy to sell candle here, and I can also see another one up here as well. I can see some inefficiency there. So we could get a more refined entry by looking at this whole last buy to sell region. And as we can see, price comes to penetrate that perfectly. So what we would do essentially is wait for price to trail back up, tap into this zone. When we see rejection from this fractal point of interest and we see a break of structure in this corrective wave, we then understand that this bullish corrective wave has finished and the next impulsive wave is ready to take place. So this would mark the last structural low within this bullish correction. So we could highlight that. And once price breaks beneath this, again, this tells me that this correction here is finished. Price has picked up enough supply here and is now ready to take its next impulse. All we would do then is we would look within this impulse that broke the structure, again, for a supply zone. So if we just zoom in, and all this is doing is looking at structure within structure within structure, I can now see another last buy to sell region here that has been left unmitigated. And if you look at that, we can just refine this slightly to this. And if you look at that, price comes to tap into this green candle perfectly and then delivers us with bearish structure. So now that we understand that this corrective wave has finished based on this break of structure, We now need to look at this impulsive wave for any supply zones, like we did do here. We looked within this for any supply zones, we found one. Again, we need to do the same here, more fractally. We found one, price is tapped in and rejected. So that tells me that there's been enough supply introduced into the market to now reverse this market entirely. So when we get the rejection, which we got, we've then had a break of structure here. This being the last structural low, we've then had a break in structure. Price has come up and trailed. Bearing in mind, this is on the 1 and 5 minutes, so this is going to be very fractal. We would then place our stop loss just above the structural highs that have been created previously, just to play it safe. I usually place my stop loss a few pips above the structural highs, the previous structural highs that were created, just to be safe. So we could have a stop loss of say 10 pips. Zoom out. We then get our take profit. We want a higher time frame take profit target. That's what we're looking for. So we mark it and we place it at the previous higher time frame structural swing low, which is here. As we can see, our risk to reward ratio now goes from a 1 to 6 to a 1 to 43. So you are risking 1% to potentially gain back 43%. As you can see, price does go on to create a new lower low. So TP would have been achieved, okay? So this is the power of looking at price action, looking at breaks of structure, looking at the laws of structure, bearish structure, bullish structure, and finding supply and demand zones. Once we have found a higher time frame supply or demand zone, we look for a break of structure based on a penetration from that zone. We look at the impulsive wave that broke that structure in the first place for another supply or demand zone. And then once price taps that supply or demand zone, we then wait for a break of structure to take place within that penetration. And then again, we repeat the process. So we go down on time frames, look at the 5 minute. We look at the impulsive wave that broke the structure based on that penetration of supply or demand zone to find any other unmitigated candles. And that is how I would look to place my positions. Now, I know it may seem a bit confusing because we are looking at structure within structure, within structure, within structure, and we are going down on time frames and we are looking at, you know, very specific things and areas, but that is how I do things. That is how I am able to get really refined entries and brilliant risk to reward ratios. If you haven't watched our October's video, I would definitely recommend going and watching it. I go through all of my trades over the course of October, my performance, how I look to place the positions, what I did in terms of getting entries. I just didn't go into as great as detail as I have done today, but you'll see that the risk to reward returns on those positions are phenomenal. Now, I hope that does make sense. As I said to you at the start of the video, if it doesn't, if there are things that you are still unsure about, if it's gone in one ear and out the other, please leave a comment below. I am going to arrange a webinar that we can all be a part of. We can ask questions, we can go through things in a slower pace, and then I can obviously answer any questions surrounding anything you're unsure about. But if you have enjoyed the video and you have learned something from this, please leave it a thumbs up. All the support you guys provide is very much appreciated. More than anything, just remember this 10-step guide. So find a bias and always trade with the trend. Look at the overall structure of the market to ensure that the bias is correct. Mark out the swing points, as this will help us determine our stop loss and take profit. Wait for a higher time frame impulse to finish before looking at supply or demand zones. Mark out the supply or demand zones within the previous impulsive wave. Wait for price to trail into these points of interest. Once price has trailed into these points of interest, look for a break of structure within that tap. Once we have a break of structure within that tap and that penetration of the point of interest, look at the impulsive wave that broke the structure for more supply or demand zones, as this will allow us to get a more refined entry on the position. All we do then is wait for the pullback. We wait for the pullback into that fractal POI that we have found. We then set our stop loss and take profit orders above and below structural highs and lows, and then we execute our position based on the rejection of that fractal point of interest. Now, obviously, within my example that I've gone through today, I went down fractally twice. So I didn't do it once, I went down fractally twice. I went from the 1 and 4 hour to the 15 minute to then the 5 and 1 minute. So that is obviously going to allow us to get extremely refined entries, but this can still be applied just by going down fractally once. This can still allow you to get a really refined entry, as I have shown you guys, but maybe just not as refined as my position here. Now, what I also plan on doing in the coming weeks is creating a video for you all based around risk management, stop losses, take profits, all that good stuff, risk to reward ratios. These are all the things that you need to have great understanding around in order to maximize profits and minimize those losses. But as I said to you guys earlier, I hope you've enjoyed this video. I hope you guys have learned something from this. And if you haven't and you're still unsure, leave it in the comments. I will get back to you and we can arrange this webinar. Now, I have been Luke. This has been another Learn to Trade episode. We will catch you guys in the next one.